Hey folks, glad you could join us on another episode of Business Redefined. This is your weekly, most comprehensive look at the world of business, finance, and economics. We want to talk about trade finance following an epic signing between Standard Chartered Bank and the British International Investment, $100 million on the table. We're privileged to have the man in charge of Standard Chartered Bank, that is Mr. Kariuki Gary. Karibu sana.
Asante.
This time we're not discussing earnings. Kariuki, please. Give us some context around the signing that has happened, why it's significant for Standard Chartered and for this market.
I think first of all, it's the quantum of what we have signed today with BII. That is British International Investments. It's trade finance goes a long way in helping trade, whether it's trade, whether it's manufacturing, whether it's whatever business you're talking about. That is what we call the oil that fuels this trade.
Yeah.
And the signing this agreement means immediately $100 million is available that we can co-share the risk with BII.
Yes.
In very simple terms, it means if a client, for instance, our appetite for that client is $1 billion shillings, for argument's sake, it means with this agreement we can actually be able to do 1.5 billion. So we've unlocked 500 million that would not have been available before. So when you look at the quantum of, when you look at it in fullness, you're talking about what, $450 million that is now available because of this agreement.
It looks like Standard wants to angle itself for large ticket size engagements in the trade finance space. Is that a fair assessment?
Yes and no. We've always been in the space of large transactions, but this one allows us even to do the smaller transactions because we are risk sharing, and that's where the risk is. The risk is actually a lot more on the smaller transactions. So with this agreement, we can be able to do a lot more with the smaller businesses as well.
Okay.
Yeah.
How will the disbursement look like? Is it sector agnostic? Are you cautious about some pockets of the market?
We want to align ourselves with what are the key sectors of what drives the Kenyan economy, for instance. When you look at agribusiness, it's big for the Kenyan business. That's important. Health, that's important. Manufacturing, that's important. That's how we are looking at it as those sectors that are critical for economic growth, that are critical for employment creation, and most important, critical for trade as well. Those are the ones we are focusing on.
Some would say it's an interesting time for this signing to be happening given what we are seeing in the global environment around tariff wars escalation and uncertainty around the global trading space. How does this signing speak to the context in which we are?
I think at any one time there's always something happening globally. But that does not mean that people stop doing business. Yeah. The most important thing is how do you realign your priorities? How do you realign how you do your business? For instance, in what's happening right now, there's going to be configuration of trade routes and manufacturing centers. Yeah. There are opportunities for Kenyan businessmen to say, actually, if this could only be done in, let's say, China, we can be able to do it here. This is a big opportunity for reallocation of resources, reallocation of capital, but most important, new supply routes are going to emerge out of this. We will, right now, there's the uncertainty about the tariffs, but it will not last forever. But most important is, after the dust has settled, who are going to be the new winners? But I hope that the Kenyan businesses and the Kenyan economy will be a beneficiary of what's happening. It's very important.
I'm curious, Kariuki, from your vantage point, what do you see as the trade finance gap that is, even if you could say in the Kenyan market, because this is a space in which you deal in quite significantly?
Oh, it's huge. We estimate it's beyond $500 million for at present moment. We see that figure is huge. Because if you look at the way the risk sharing, the risks the banks want to take, or whether development institutions they want to take, they'll always, the reason why they will not go, if a client, for instance, wants $1 billion shillings, you probably say you put in 30% or 40%. It's all because of you're looking at the risk and saying I don't want to take the full risk. So the gap is huge. Partnerships like this, partnering with clients like BII, makes a difference.
I see.
Yes.
My final question, Kariuki, is this: why strategically go for a DFI for this sort of an arrangement?
Because that's what they do. That is what they do. I think they've got the capital. They want to be able to invest in these businesses. We are very strong in origination. We are the ones in direct link with the client. They are not. So they look for a partner like us because we can be able to originate. We are speaking to these clients. They are doing business with us. So we are able to originate and see the good clients that we would like to do business with. And they come and support us from that side. So I would call it a perfect partnership.
Quite symbiotic. Yes. Allow me to close with this. If I'm a trader or if I'm in the trade space and I'm watching this and I'm wondering, why should StanChart be in my first port of call when I'm thinking about my trade finance solutions? What would be your answer?
We'll probably give you more than you needed. We'll probably be able to cover you a lot better than what other competitors might be able to offer you. That would be my answer. That you come to us, come talk to us. We understand your business. We have got many supply routes. We've got many partners not only across Africa, not only from Kenya, Africa, and beyond the borders, whether it's Africa, Middle East, and Asia, where our footprint is. So we're able to give you exposure to a lot more markets than you'd otherwise get if you're not dealing with Standard Chartered.
All right.
Yes.
And there you have it. We've been having a conversation with Mr. Kariuki Ngari from Standard Chartered Bank, speaking about trade finance and why this bank is your port of call when you are scouting for these solutions. Stay tuned. We'll continue unpacking this and a lot more. Welcome back to this conversation where we are talking about the landmark signing between BII, that's British International Investment, and Standard Chartered Bank. In the first leg, we spoke to Kariuki Ngari about the origination side and why this signing is critical. We're now joined by Seema from BII. Pleasure to have you on set.
Absolute pleasure to be here. Thank you very much.
Maybe just give us a 101. Tell us about BII and what you do.
Sure. So British International Investment is the UK's development finance institution. We are the oldest development finance institution in the world, and we've been supporting investments in Africa and South Asia for over 75 years now.
All right. $100 million. Why is this signing particularly critical for your undertaking in this part of the world?
I think it's incredibly important because it reaches our real mission. We are an impact investor. And so as a DFI and an impact investor, we want to hit the grassroots of our economies. So this particular transaction is really supporting the East African region in critical sectors. So for example, agriculture, healthcare, manufacturing, these are incredibly important for the East African economies. They contribute significantly to the GDP. And through Standard Chartered, we're enabling local businesses, SMEs to do more. And that's really what we want to do.
Seema, as you talk about SMEs, majority of the players you'll talk to on the financing side will tell you, when you talk about MSMEs rather, we struggle with bankability and the viability of recouping your investment. How do you navigate that space?
I think that's true, and I think it's a journey. DFIs like us are really there to try and address structural inefficiencies, and so trade finance is one of those mechanisms through which we do that. And we recognize that it's difficult. It's difficult for banks to really assess risk in the MSME sector. And so by supporting them and being like a backstop and providing guarantees to the banks, we're trying to encourage them to do more, to lend more, to take greater risks. So that's where we play our role, is to try and help de-risk the local environment for the banks. The banks are those institutions that know their environment better, they know their businesses, they know their clients more intimately, and we backstop them to try and do more for them.
I see. What sort of catalytic impact do you expect this to have with regard to crowding in even more participation in the trade finance lending space in this market?
So I think it's really about looking at trade finance as a tool. So this is a $100 million deal, which is phenomenal in itself for this region. But if you think about it, trade finance is a short-term mechanism. It rolls. So the potential for this is far greater. It could even reach up to $450 million because as we revolve and churn trade finance through any sort of 1 year period, it has exponential growth possibilities. So that's absolutely critical. But really, fundamentally, what it does is it enables the SME to grow and to scale. It hires more people.
Yeah.
It creates greater skill sets within the economy. It enables trade flows both within the economy and externally for that entity, and increases exports, which is again one of the things that are fundamental, bringing in FX into the economies.
Absolutely. Seema, whenever we talk to MSMEs, one of the issues they raise with us is that over and above capital, part of what we require is technical capacity, just to be able to get our business models right. Is that something which BII in one way or another deals with as well?
We do. We have a separate group within BII called BII Plus. It's our technical assistance group, and we support clients pre-deal as well, not just post. So previously, BII would enlist the help of technical assistance facilities post an investment, but actually now we do it pre-investment to almost get them investment ready, to introduce things like human capital management, how to think about a board, how to think about governance structures, etc. And those are all critical aspects for SMEs to enable them to grow, and to grow in a way that attracts international investment too, both local and international. So it's all part of the sort of value addition toolkit that DFIs like ourselves can assist in.
On your parting shot, Seema, as we close this conversation, what would you say to the MSMEs operating in Kenya, in East Africa, in Africa? Because the truth is, we are in an environment which has been characterized by a lot of volatility. We're now seeing escalating tensions in parts of the world, in the Middle East. We've been talking about tariffs, etc. What would be your parting shot?
I think it's about doing your homework. There is capital available. You know, we talk about a dearth of capital. There's capital available. So please do your homework as to who is out there, who can support you. There are so many programs, and it's not just about grant funding. It's about more than that, right? So there are many SMEs that I've come across that have had USAID funding, for example. Let's just go straight to the point on that one, right? Which is no longer there. And the issue is with that is that they've been used to financing essentially at zero cost. Yeah. And that is not what DFIs do. We help to support these entities grow, but we also ask for a commercial return. It might be slightly less than a bank would, but it's important because these entities need to grow and scale so that banks can support them beyond us after we've come in. So it's incredibly important for these MSMEs to research, to figure out who can support them, not just with grant funding, potentially with concessional funding, with technical assistance, as you've mentioned, and other forms of facilities. But also it's about trying to get the right facility, a structured facility for them. It's not just about using overdrafts. They'll cripple you, right? So it's about exploring options within financing mechanisms that exist today that really work for you, the specifics of your ins and outs, you know, that work for what you need and the time spans that you need, so they're not overburdened as well. So I think it's just doing homework, really, and reaching out. You know, sit with your relationship manager at your financial institution, reach out to the DFIs. And we're always there to support. If we can't fund someone, we always ensure that we pass an opportunity on to those who we know in the network can.
Yeah. Wonderful. We've been having a conversation with Seema, and her last point on thinking beyond grant financing as well as solutions such as overdrafts is a good scene set for our next conversation, which will be drilling specifically into trade finance solutions and why this particular signing between BII and Standard Chartered Bank is quite critical. Stay tuned. Welcome to the last leg of our conversation on trade finance following the signing between the British International Investment, that's the DFI from the UK, and Standard Chartered Bank, $100 million. We're privileged to have Freddie on set with us. Freddie, you're welcome.
Thank you very much.
Begin by telling us who you are and what you do at BII.
So my name is Freddie Tucker. I'm based here in Nairobi, and I handle our relationships with all our banking partners in the region. Predominantly, I focus on trade finance, so looking at how to help our banking partners grow their trade finance books.
All right. A number of banking sector players tell me that this market is really skewed towards particular solutions, letters of credit, suppliers credit, overdrafts. When you look at it from the BII side, how do you tailor-make your solutions to address the market needs?
Right. So we're a big believer that structured trade finance is really important for growing these economies. And so when I say structured trade finance, I mean the full range of trade finance products that are available to borrowers. So like you say, those include letters of credit, payables finance, receivables finance. There's quite a wide range that can be offered. So we seek out partners who are specialists in these areas. And Standard Chartered is a great example. Standard Chartered have an international reputation for offering these kind of trade finance products. And we want to support them in offering those to the market.
I see. Tell me about why this particular partnership is critical. I'd imagine that you are seeing particular opportunities, particular gaps in the market that you want to plug in and address.
Yes. So the trade finance gap globally is reported at about $1.3 trillion, and about $150 billion of that is in Africa. So there is a big gap. I think what's really important to note is that 80% of employment in Africa is through SMEs. So ensuring that they have the sufficient finance to grow is vital to employment in this continent. Standard Chartered is a really important partner for us in that respect, because the greater the level of trade finance we can provide to the market, the more we'll see growth in prosperity, growth in jobs, growth in development. You know, it's well documented that increase in trade increase in development.
You've got a very, if I could call it, unconventional perspective on something which majority of the finance players tell me, MSMEs, good opportunity, poor bankability. You take a different view.
Yes. Well, trade finance is cash flow based lending. Now, that's much more difficult and much more intricate than typical term loans, which look at assets, that looks at the land or the asset book that the company might have and lend against, say, 80% against that. When you do trade finance, it's very operationally involved. So there's pieces of papers flying all over the place. There's security over the goods involved. But what that means is you can help businesses that may not have assets to securitize their loan. It means you can finance smaller businesses who may have won contracts with big off-takers or have good access to supply networks or supply routes or a new processing method. So it allows us greater tools and greater abilities to help a wider portion of the market, but it does require more work.
All right. And tell us about the necessity of risk sharing, because this arrangement is essentially a risk sharing framework. Why is that particularly important, especially in the environment we are in currently, where we are seeing a lot of global volatility?
It's a very good question. I mean, DFIs and BII in particular are meant to be counter-cyclical investors. So we take risks where others won't. And when you see volatility globally, whether that be wars in the Middle East, wars in Eastern Europe, greater inflation, uncertainty, that's where we really can step in. So we get to support banks like Standard Chartered with our risk appetite. So we have a greater level of risk appetite than others might do or might not do in this kind of market environment.
And sustainability increasingly is ingrained in every bit of lending. I'd imagine even trade finance. How do you ensure that you are addressing the needs of sustainability?
Well, I think we have to consider everything through the value chain. So we do a lot of work looking at who the suppliers are, who the processors are, who the off-takers are. They're very long value chains, and you need to make sure that these value chains adhere to sustainability practices right the way through. And we need to work with banks who also adhere, who also monitor and look at those sustainability practices. And again, Standard Chartered, we share values, we share an ethos, and we share a commitment to sustainability. So for us, working together is a really good partnership.
As we wrap up our conversation, Freddie, as someone who previously worked in the transaction advisory space, one of the things which was always an elephant in the room was about the deal size. Because DFIs would come with so much appetite, but they'll tell you the market is a bit too fragmented, too small ticket sizes. How do you go about that?
Yes, it's a common complaint that we hear all the time. Well, working with banks allows us to go down the value chain and work with smaller organisations. Standard Chartered and other banks in the market are equipped to deal with smaller businesses. They have a much greater number of branches, much greater number of people, and much greater processing power than we do. We have risk appetite, so we help them grow their books, but they are the front, and it is their clients that we help to support and grow.
Freddie, my final question. We're talking about trade finance, and we cannot be oblivious of the fact that the conversation which has dominated the globe ever since the last 6 months has been tariffs and tariff escalation. How do you see that impacting the trade finance space?
That's a very interesting question. I mean, it's caused a lot of consternation globally, I think. For Africa, it's very different. Africa is predominantly an export nation, and the things that are exported from Africa very important and very needed globally. So whilst it's caused a lot of turbulence in the market, I think we still need to see what the long-term effects of this are going to be. And I'm still very positive and very hopeful for Kenya and for Africa's future in trade.
Fred Tuck has been giving us his perspective as far as trade finance is concerned, as far as when it comes to solutions and also the trends we are seeing in the global environment, closing on a very optimistic note that despite all the tariff conversation we're having, the opportunity is still massive for the African continent. We'll continue highlighting this to be able to position our businesses to take the optimal use of these chances as and when they come. Stay tuned to Business Redefined.